Right now, in dealer lots all across America, more than 3 million cars are sitting there unsold, untouched, baking under the sun, collecting dust in giant lots the size of airports. And behind every single one of those cars is a number that should genuinely scare you. $1.7 trillion. That is how much debt Americans currently owe on auto loans alone. Let that sink in for a second. $1.7 trillion. More than the entire yearly economic output of countries like Canada or Russia. All of it sitting on car loans for vehicles that are losing value faster than at any point in the last 2 decades. And here is the part almost nobody is talking about. While that debt keeps climbing higher and higher, the cars themselves keep piling up on dealer lots because regular people simply cannot afford to buy them anymore. So picture 2 mountains. On one side, a mountain of debt. On the other side, a mountain of unsold inventory. And when 2 mountains like that collide, something has to give. Something always gives. If you're even thinking about buying a car sometime in the next 12 to 18 months, I need you to stay with me for the next few minutes, because what I am about to show you could genuinely save you thousands of dollars. I'm going to walk you through 5 signals, 5 data points that the auto industry does not want you paying close attention to, and once you see them laid out side by side, you're going to understand exactly why we are heading toward one of the biggest price resets the car market has seen in decades. And I promise you, by the time we get to signal 5, you're going to look at every single car commercial, every 0% financing banner, and every dealer lot you drive past on your way to work completely differently. Because underneath all that shiny paint and those low monthly payment ads, there is a story most buyers never get to see until it is already too late for them. Before we get into it, hit that subscribe button and turn on notifications. Because on this channel, we break down exactly what is happening with your money, your debt, and the economy around you in plain English with no jargon and no Wall Street spin, just the truth about where your dollars are actually going. My name is David Marshall, and for years now I have been tracking consumer debt, credit markets, and the auto industry, translating the same numbers Wall Street watches into something you can actually use before you ever sign your name on that dotted line. So stick around, because signal number 1 alone might make you think twice about ever trading in a car with a loan still attached to it. To really understand why we are standing at this moment, you have to rewind back to 2021. Semiconductor chips, the tiny computer brains that run everything from your dashboard screen to your airbags, suddenly became almost impossible to get. Factories overseas shut down, shipping containers got stuck in ports for weeks, and automakers physically could not build enough cars to meet demand. At the very same time, the government was pumping stimulus checks into everyone's bank account, and Americans, flush with cash and stuck at home with nowhere to spend it, decided this was the perfect moment to finally buy that new car. So picture this: extremely limited supply crashing head first into massive stimulus-fueled demand. That combination is basically the textbook definition of a bubble, and dealers knew exactly what was happening. They started slapping what the industry politely calls dealer markups right onto the sticker price. We are talking 10 to 70% over MSRP. A Ford Bronco that was supposed to sell for $38,000 was rolling out the door for $83,000. Not a typo. $83,000 for a truck built to sticker at $38,000. And people paid it. They paid it because they were terrified prices would climb even higher tomorrow, because dealers kept insisting inventory was drying up by the day, because everyone around them seemed to be buying, so fear of missing out completely overrode logic. Here's the problem with buying anything at the very top of a bubble though. Bubbles always pop eventually. Chip supply recovered, interest rates shot up, and the exact same people who overpaid back in 2021 and 2022 are now trapped in loans worth more than the car sitting in their own driveway. Which brings us to signal number 1, and honestly, it is the one quietly wrecking people's finances right now while they barely even notice it happening. Signal 1 is something the industry calls negative equity, but you and I would just call it being underwater. Here is what that actually means. You buy a car, you finance it with a loan, and over time the car's value drops faster than you're paying down that loan balance. So at some point, you owe more money to the bank than the car is even worth. Right now, 1 in every 4 trade-ins in America carries negative equity, 1 in 4, and the average upside-down loan balance has hit a record high of $6,838. That means if you tried to trade that car in today, you would still owe almost $7,000 on a vehicle you no longer even own. Let me introduce you to someone I will call Derek Coleman, because his story is playing out in driveways all across this country right now. Back in 2022, at the absolute peak of the car buying frenzy, Derek bought a brand new Tesla for $72,000. He financed almost the entire thing, convinced it was a smart investment in cutting-edge technology. Fast forward to today. Tesla has slashed prices multiple times, competition from other electric vehicle makers has exploded, and Derek's car is now only worth about $38,000 on the used market. Here is the gut punch. He still owes $52,000 on his loan. $52,000 owed on a car worth $38,000. That is a $14,000 hole he is sitting in, and every single month interest keeps adding to it. This is exactly why I keep telling people, do not dig yourself into a deeper financial hole by trading in with negative equity. What happens to people like Derek is that dealers offer to just roll the negative equity into a brand new loan, wrapping old debt into new debt, and the cycle resets itself even worse than before. It feels like a solution in the moment, but it is actually quicksand, and every year that passes, more Americans are stepping into it without realizing what they are signing. Let's keep score for a second because this is only the beginning. Signal 1 just showed us that 1 in 4 Americans trading in a car right now is already underwater before they even walk into the next negotiation. 4 signals still remain, and honestly the next one might be even more painful than this because it hits every single car buyer in America, whether their loan is underwater or not. Now let's move to Signal 2, and this one is going to hit you where it really hurts, your monthly budget. This is what I call the financing squeeze, and I want to walk you through an actual side-by-side comparison so you can see the hidden cost of credit with your own eyes. Let's use one of the most popular cars in America as our example, the Honda Accord. Back in 2021, a Honda Accord had an MSRP of about $31,000. Interest rates on auto loans were sitting around 2.5%, which was historically cheap money. Insurance on that same car ran about $150 a month. When you add the loan payment and insurance together, the total monthly cost of owning that Accord came out to roughly $611 a month. Now let's jump to 2025 and 2026. Same car, same Honda Accord, same $31,000 MSRP. Nothing about the physical car has changed. But interest rates on that loan have climbed to around 6.3%, and insurance premiums have jumped to about $225 a month. Add those together, and the total monthly cost of owning the exact same car is now roughly $731 a month. Let that comparison sink in. Same car, same price tag on the sticker, yet interest and insurance increases alone have added about $7,200 in extra cost over the life of that loan. $7,200, which is roughly a full quarter of the entire value of the car, added purely through the cost of credit and the cost of coverage. Nobody warns you about this part when you're standing on the dealership floor staring at a shiny new vehicle. The sticker price stays the same, but the true cost of driving that car off the lot has quietly climbed by nearly a quarter. And here is where it gets even more difficult for regular buyers. Because interest rates have climbed so aggressively, lenders have tightened their standards dramatically. Nearly half of all auto loan applicants right now are getting rejected. Nearly half. That means for every 2 people walking into a dealership hoping to finance a car, one of them is walking back out with nothing but a denial letter. This is what analysts call auto loan tightening standards, and it is happening at the exact same time subprime lending patterns from years past are starting to repeat themselves, with riskier borrowers getting pushed into higher and higher interest rates just to get approved at all. So now you have buyers who cannot get approved, buyers who are underwater on their trade-ins, and buyers who are paying hundreds of dollars more per month than they would have just a few years ago for the exact same car. Which leads us directly into signal number 3, and this is where things start to visually show up on dealer lots themselves. Signal 3 is unsold inventory buildup, and the numbers here are honestly staggering. Dealer inventory across the country is up 120% since 2023. There are now more than 3 million unsold vehicles sitting on lots right now, waiting for buyers who simply are not showing up in the numbers they used to. To put that into perspective, dealers currently have about 90 days worth of supply sitting on their lots. Back in 2022, at the height of the shortage, that number was only 18 days. 18 days of supply compared to 90 days of supply today. That is not a small shift. That is an entire market flipping upside down in just a few years. Think about what that actually means from a business perspective. Every single car sitting on a dealer lot costs the dealership money every single day it sits there. Most dealers do not own those cars outright. They borrow money to stock their lots in what the industry calls floorplan financing, which means interest is quietly accumulating on every unsold vehicle every single day, whether it sells this week or sits there for 3 months. Financing costs, insurance costs, storage costs, all of it stacking up the longer that car does not sell. And when inventory keeps piling up like this, dealers eventually have no choice but to react. Dealers are panicking, the incentives are starting to roll in. Walk onto almost any dealer lot right now and you will start noticing it yourself. Rows and rows of the same model, the same color, sitting there untouched for weeks. Salespeople getting more aggressive with their offers. Manager specials popping up that were not there 6 months ago. This is not generosity from the dealership. This is survival mode, plain and simple. You are going to start seeing more cashback offers, more 0% financing promotions, more aggressive lease deals, because dealers desperately need to move metal off their lots before it becomes an even bigger financial liability for them. But here is the twist most people are not seeing yet, and it connects directly into our next signal. This inventory buildup is not just happening because fewer people want to buy cars right now. It is also happening because the manufacturers behind these cars are facing serious trouble of their own, trouble that is now spilling directly into layoffs and production cuts. Signal 4 is what I call the industry cracking from the inside, and Nissan is the clearest example of just how bad it has gotten. Nissan recently reported a 90% drop in profit. 90%, not a slight dip, and almost complete collapse in profitability. In response, the company announced it is cutting 9,000 jobs worldwide and reducing production by 20%. Nissan is even exploring some form of consolidation with Honda, essentially two competing automakers being forced to consider joining forces just to survive the current environment. When you see a major global automaker cutting production by 20% and slashing thousands of jobs, that tells you everything you need to know about where actual consumer demand is heading. Automakers do not cut production because business is booming. They cut production because they can see months in advance that the cars sitting on those lots are not moving fast enough, and they are trying to avoid flooding an already flooded market with even more unsold inventory. This is industry consolidation happening in real time, right in front of us, and Nissan is very likely not going to be the last major name we see struggling this badly. And just when you think the car market could not possibly get more complicated, there is one more signal on the horizon, and honestly it might be the biggest one of all. This is Signal 5, and it involves a policy decision that could reshape the entire auto industry almost overnight. Signal 5 is the 25% import tariff threat. There has been a proposal for sweeping tariffs of 25% on imported vehicles and auto parts. To understand how massive this is, consider that imported vehicles and components currently make up about 45% of all light vehicles sold in the United States. That includes roughly 3.6 million cars coming in from Canada and Mexico alone every single year. Vehicles built under decades-old supply chain agreements that assumed largely tariff-free trade across North America. If these import tariffs go into full effect, economists estimate imports could drop by as much as 74%. Automakers would either have to absorb these new costs themselves, which would crush their already shrinking profit margins even further, or they would have to pass those costs directly onto consumers through higher retail prices. And given what we just talked about with Nissan's 90% profit collapse, do you really think these companies have the financial cushion to absorb a 25% tariff hit without passing it along to you at the register? This is where everything we have talked about collides into one single moment. You would have average transaction prices climbing even higher because of import tariffs and customs revenue costs getting baked directly into sticker prices. At the exact same time, you already have millions of unsold vehicles sitting on lots because consumers are already stretched too thin to buy at current prices. Higher tariffs would only add fuel to a market that is already struggling with retail price resistance, where buyers are simply refusing to pay what dealers are asking. You cannot raise prices on a market that is already rejecting the prices you are currently charging without something eventually breaking. And here is the part that makes this signal so strange compared to the other four. Every other signal we have covered so far points toward falling prices and desperate dealers. This one, the tariff threat, points in the completely opposite direction, toward higher prices on any vehicle that relies on imported parts or import assembly. So you end up with two completely different forces pulling the market apart at the same time, falling demand pushing prices down on one side and tariffs threatening to push prices up on the other. Nobody, not even the analysts who study this for a living, can tell you with certainty exactly how that tug of war ends. But one thing is clear, whichever way it breaks, it will not be gentle and it will not be gradual. So let's zoom out and look at the complete picture together, because when you line up all 5 signals side by side, the pattern becomes impossible to ignore. Signal 1, negative equity, with 1 in 4 trade-ins underwater and average upside-down balances at a record $6,838, trapping buyers like Derek Coleman in loans worth more than their own cars. Signal 2, the financing squeeze, where identical cars now cost thousands more purely because of interest rate hikes and rising insurance, while nearly half of all loan applicants get rejected outright. Signal 3, inventory levels up 120% since 2023, with over 3 million unsold cars sitting on lots for 90 days at a time instead of 18. Signal 4, layoffs and production cuts tearing through the industry, with Nissan's 90% profit collapse standing as a warning sign for the entire sector. And Signal 5, a 25% tariff threat hanging over the market, one that could choke off nearly 3/4 of vehicle imports and push prices even higher at the worst possible moment. The car market is facing a perfect storm of high rates, massive inventory, and tapped-out consumers, and right now the average new car payment in America has climbed to $742 a month. $742 every single month just for the privilege of driving a new vehicle. And here is a number that should stop you in your tracks. 1 in 6 car buyers right now is paying over $1,000 a month on their auto loan alone. 1 in 6. Think about what that does to a household budget, on top of rent or a mortgage, on top of groceries, on top of everything else climbing in price around us. So what does all of this actually mean for you if you are watching this and thinking about buying a car in the next year or so? It means patience right now might genuinely be the most valuable financial tool in your entire toolbox. Dealers are already panicking, the incentives are starting to roll in, and as unsold inventory keeps climbing and layoffs keep spreading through the industry, the pressure on dealers to cut real prices, not fake discounts but actual meaningful price drops, is only going to intensify from here. Waiting on the sidelines while this plays out could very realistically save you thousands of dollars compared to buying at what may end up looking like the top of this cycle, the exact same way Derek Coleman got caught buying at the top back in 2022. And if you already own a car with a loan attached to it, please do not dig yourself into a deeper financial hole by trading in with negative equity. If your car is currently worth less than what you owe, rolling that gap into a brand new loan almost never solves the problem. It just buries it deeper and adds more interest on top of an already bad situation. Sometimes the smartest financial move is simply to keep driving the car you already have, pay down that balance, and wait for this entire market to reset itself before making your next move. I have watched a lot of financial cycles play out over the years, and this one has all the same warning signs we have seen before: cheap money leading to overpriced assets, followed by tightening conditions that eventually force a painful correction back toward reality. Cars are no different from housing or stocks in that sense. They are simply assets that got wildly overpriced during a very unusual moment in history, and now the market is fighting its way back towards something that actually makes sense again. Think back to Derek Coleman for a second. He did not do anything reckless or foolish. He walked into a dealership at a moment when everyone around him was telling him to buy now before prices climbed even higher, and he trusted that pressure. That is the exact same pressure being applied to buyers today, just dressed up differently, low advertised payments instead of shortage warnings. The tactics change, but the trap underneath stays exactly the same. Recognizing that pattern before you're standing on the dealership floor is the entire difference between being the person who waits patiently for the reset and being the next Derek Coleman 2 years from now. If this video helped you understand what is really happening behind the scenes in the auto market, do me a favor and hit that subscribe button right now, because I am going to keep tracking every single one of these 5 signals as they develop over the coming months, and I will be right here breaking down exactly what it means for your wallet in plain, honest language. Drop a comment down below and let me know, are you planning to wait this out, or do you think prices are already low enough to jump in? I read every single comment and I want to know where you stand. Until next time, protect your money, stay patient, and do not let fear of missing out talk you into a decision you will regret 2 years from now. I am David Marshall and I will see you in the next one.